Hopefully that fixes it. Yeah, I'm showing that there is sound coming through. If there isn't on someone else's end, maybe it's on your side, but it does look like it's working well. All right, anyways, those are the challenges that we have with live. I will see this later and see if it's actually a problem or not. And if so, it might just be a scratch thing. So I'll deal with it then. Anyways, I'm going to keep moving through and we're going to go through this kind of stuff. All right. Okay, all good now. Okay, good. Um, Thanks. I'm glad for the comments there. I was looking through and seeing if there was sound, but it looked like everything was okay. So I appreciate you letting me know either way. And we are going to run through what I was planning on running through. So let's first look at what's going on as far as our Fed balance sheet. As you guys know, that is a large driver of kind of how risk on and risk off shows up. So as far as that's concerned, we did have our little spike back here when we had a little bit of some bank issues and things like that. It didn't turn into anything crazy, which is a positive thing for the economy. But anyways, we have continued to just start to sell off those assets yet again. So they basically just one little skip, and then now we're back to where we were prior to those bank. And so we're still continuing to sell off. That is some negative pressure on bonds, right? There's some negative pressure on a lot of things. And you can see I put this on a logarithmic scale just to kind of show how much buying and selling we've done and how much the Fed balance sheet has grown. Yes, it hasn't been a straight line, but this is one of those tactics that they're using to uh, ease financial conditions or tighten financial conditions. So even though they're pulling back the reins on interest rate hikes, they are not yet on the Fed balance sheet. So they're still tightening their books. And so that does create a little bit of headroom or a little bit of pressure or a little bit of headwinds on stocks and bonds and things like that. So that's where we're at as far as that's concerned. We are going to focus in on this little guy right here, though. And when we zoom into, let's go on. So when we zoom in, we can see a signature that happens. And let me turn this into a candle because candles are a little bit easier to see this on. All right, so there is a specific signature right here that happens, and it is this kind of parabolic type of signature, right? These parabolic signatures are most of the time reserved for kind of crashes, right? So, you can see here, this is a crash and you can kind of see this meltdown, right? And then it spikes back up, right? This is very common to the downside. It's very, very common to the downside. Here's your little rollover and a drop down. It's this vicious kind of spike. But it does happen to the upside as well, right? You can see here, this is a little parabolic move up. I know that wasn't super curved, and then let's kind of show. So here's we can pull it into. Here's a Volmageddon. So this is you can see we're kind of running along here, running along here, running along here, and then we just accelerate to the upside. That acceleration at the top ends of ranges and things like that typically signals that there's a what I like to call just a leverage on move. And let me speak to the mechanics behind it first. So the mechanics behind a leverage on move is when volatility is compressed, the statistically money managers and hedge funds and institutions, they will invest more into, say, that asset, right? Whatever asset we're dealing with at that time, because statistically it has less risk due to its volatility decreasing. The more volatility decreases across all assets, the more they are willing to leverage up because volatility is shrunk, right? This is just typical behavior in general, but then as volatility shrinks more when they've put in more, and then volatility shrinks again, then they put in even more, and then volatility shrinks more, and they put in more. So it creates this, perpetuating cycle of just more, 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 more. And then what happens is you start to get returns. And as those returns show up, right, as those assets that they were buying into because the volatility is decreased starts to elevate, and you start to have profit in your positions. Well, most institutions use leverage of some sort, whether it's through options, futures, margin. So as you become profitable, then they reduce their downside risk by that margin, right? I shouldn't say reduce their downside risk. Let me rephrase that. What they do is they utilize the same amount of margin that they had minus their profits, right? So they have all these profits baked in, which allows them to put more money in because they have more money, right? So more money creates more money, creates more money, creates more money. And then inevitably what happens is you get these big accelerated moves, and that's what kind of happens. Well, inevitably, this leverage on situation gets prices to a point where they're not as attractive, or the risk reward gets a little bit off kilter, or the volatility starts to actually increase at the top end. And that volatility increase at the top end is what normally pulls back the range just a little bit, because statistically they're not allowed to increase their leverage anymore because the volatility is starting to expand. And what that creates is it creates these kind of little stall pockets as retail investors have came in, traders have came in, all that kind of stuff. And these little stall pockets end up creating a little bit more volatility. And then it starts to create a sell off as that risk on behavior gets reversed a little bit from institutions. And then that will typically turn into, oh my God, now volatility is spiking. And then now we got to sell more, volatility spiking more, we got to sell more. And it's a very quick smack, right? It's a very quick, vicious drop that happens after them. And this happens a lot, right? This is pretty much typical behavior in this environment, which we've talked about that in the Adapt Advanced, where it's just click, 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 boom, big drop, and then it'll just clip back up again. That's different than a bubble. We can see bubbles are pretty rare back here. Here's one that you can kind of see where we start to march up, top into the range, everything kind of slows down, and then it just all of a sudden starts accelerating up. That's typically unsustainable. We get that compression that's just for a second and then a quick drop. And then it goes back to where it was before that acceleration started to take off. That's very, very, very common. And then it can just go on doing its business again. So let's see where we're at right now. We can definitely see that the NASDAQ is definitely in one of those bubble type of modes. We've already had one day of kind of a comeback to reality mode. It typically, I'm not saying it will, but it typically checks in at this level, right? Right when it starts to go parabolic is when it'll typically, kind of stop itself. This is the first day that we've come underneath these kind of trend lines. If you were to draw a trend line, I can draw this a little bit better with something like this, but this is our typical move up that we would have expected. Boing, kind of go up at a normal rate, then kind of bounce again and just kind of do the normal bouncy ball type of action. Whenever you see these accelerations, that's when you get a little bit of a different signature. So let's kind of put that in place. So here's that next signature, and then let's put another one on because it started to accelerate. And then so we're somewhere around here, or even here is probably reasonable, right? So this might be all we get back on this little pullback and we continue to bubble up, right? We can have a couple different situations where we kind of do that. You normally do like to see some sort of a pullback before you draw one of these. Before I had it right here, which would mean that we just broke through and that we're going to now kind of come back to the normal rate. That would be at the lowest point. It would actually be right here would be our first check-in, or it'd be right here if it really wants to fully check in. It just depends on the catalyst at the time. So these are how you kind of see if you've got these regular bubbles, kind of how you watch them out. How we play them is different. In the Adapt Advanced, I go significantly deeper into that, and so that's for those members as far as they know how to deal with these. But there are very, very, very profitable things that you can do in these types of situations without taking a ton of risk. What I will say though is that what a lot of people will do, especially in the options world, the delta neutral type of traders, or the market income or the income options traders, those kinds of trades will end up typically they'll be forced to go very bullish. They'll be very heavy in put vertical spreads and things like that to try to maintain this positive delta, to try to combat this aggressive move to the upside. But unfortunately, what that ends up doing is that even if they can sustain it and try to break even on the way up, or even make a little bit of money on the way up if they have an open-ended upside, that drop that happens at the end will typically be very painful and blow them out, and a lot of the times it'll be some of your largest losses. That was what happened in the old famous Volmageddon. Through this, people were loading up on bullish trades, bullish, bullish, bullish. It's even more aggressive in the SPX. I think it was the most aggressive in the Russell or something like that. But you can see the same pattern of you going up and then all of a sudden you just start accelerating, right? Now, when does it come to an end, right? That's always one of those things that you can do as far as drawing your normal trend lines or something like that to just see where your normal supply line is and your demand line is. So this is your normal demand, everything's fine. When you don't check back in on your demand and then you accelerate to the upside, that's when you know you're pretty much in a bubble. So then you've got to draw a new demand line, which would be like this, right? And then after you've got a couple down days up here and it still doesn't check in, right? Then you've got to basically lay one more demand line on. And then once that snaps, once the demand line snaps, then you know the leveraging up is over. Now it's back to what's going to happen, and it typically drops out pretty aggressively and pretty quickly to check back in where it was. So if you can make these fans, basically, these fan lines, I would say, with a demand line. I talk about demand lines. I follow, pretty much kind of like Wyckoff rules in general. But that demand line is what accelerates to the upside, and that's when you got to watch out for that. And that's what can create these bubbles. Now, not every bubble ends in a death sentence, right? So here is another bubble that accelerated up, and then of course you've got the drop. So that's your typical one. Here's another one where you go up and then accelerate up, and then you get your check back in. So that's pretty normal. But I want to show you guys one where we don't do that. Let's see if I can find one. So here's an okay one, right? Here's kind of like a mini one where you bounce up, you look like you kind of compress, and then you re-accelerate to the upside. This one just gets a little bit more volatile up here and eventually does have a snap and go, but it's not very aggressive, right? It's not like it turns into a crash. So that happens sometimes. Here's another one where you kind of come up to the compression zone where everything starts to kind of relax and cool off, and then you re-accelerate to the upside. This was actually the end of the bubble. We were talking about this before the recession, that it was going to be an issue. But anyways, so you do occasionally get them. Here's another one where you kind of come up and then re-accelerate, and then it just kind of fizzles out, right? So you have basically your fizzles and you have your snaps. The longer the bubble goes on, the stronger the snap is going to be. So we're still pretty early in this one, right? You can kind of see here, we kind of come up here and then we kind of re-accelerate, but it's still kind of really early in this one. I would say that the S&P really isn't in an aggressive bubble like the NASDAQ is. And then of course, if we go down to say something like the Russell's not in a bubble per se. It's just coming off of its lows from the super freakouts, right? Growth stocks have been a really good play over the last month or so because they've been really beaten down for a long time. I've actually liked the Russell since back here when there was a bunch of freaky things about banks and stuff like that. We've gotten some EEM in the portfolio and stuff like that, but just know that this Russell will kick in pretty strongly soon here in Sleep Well and Awake with certain things. But anyways, like I said, one thing to note is that Sleep Well and Awake, we measure capital flows and we measure risk from in a more traditional way of seeing like where money management is going and traditional portfolio management. So there are times that that Sleep Well and Awake can be kind of pulled into these bubbles and go pretty aggressively long on them. Right now, that's not the case. As you guys know, we have a lot of EM and bonds and Awake, and then we are pretty much mixed across the board on the dollar SPY and the dollar SPY. We have a little bit of bonds and a little bit of EM, and so we'll see that kind of balance out. Like I said, Sleep Well portfolio is always a little bit slower than Awake. Let me check in on questions here really quick. Nope, we're doing good. All right, by the way, if you guys have any questions or you want to throw anything out, go ahead and throw that in there. I can always stop and discuss them in more detail. So, like I said, as far as markets go and things like that, there are some things that are in bubbles. The NASDAQ is definitely in a bubble right now. The NASDAQ will most likely have more downside volatility. That is clear as day watching it today, right? That's just how these things play out. We have now snapped that aggressive demand line, and it's going to have more volatility to the downside than the things that aren't in bubbles. Russell's not in a bubble. The S&P is in a very light, it's kind of a semi-bubble, right? It's not even that aggressive. So this one probably won't have a ton of downside either, although volatility will still spike in it. The Dow, definitely not in a bubble, right? So we're really only seeing one asset that's very, bubble-licious right now that will most likely have a little bit more of an aggressive pullback. So very dangerous to the downside in the NASDAQ, or to be sucked into, AI stocks and things like that. Granted, they're going to be phenomenal in the future, I'm sure, or at least I'm relatively sure. As far as right now, it is a little bit more downside risk to upside just because that demand line is finally snapped. The S&P is a good little deal, and then so is the Dow and the Russell. Okay. So as far as the dollar is concerned, I got asked, how, will the dollar continue to gain strength? What's going on? Things like that. Well, the dollar is going through these kind of waves. Like I said, after there was a couple weeks ago that we talked about this, where other countries kind of catch up to the reserve currency. And they are catching up right now, which is what's creating that strength in the dollar again. But as we all balance out, these gyrations will kind of slow down. And I wouldn't expect the dollar to continue strengthening too much further. If we do, maybe a little bit, but I would expect that we will most likely be the first or one of the first to start kind of easing financial conditions and things like that, because the dollar's inflation rate will actually pull down pretty solidly at this point. I can probably pull up the inflation rate here. I've probably got it somewhere up here. So here's our year-over-year inflation rate. We're going to zoom in. We're going to zoom in a little bit further than that. So you can see here, we're down here at like 4.9. We're rolling over, coming down in here. We should, as long as everything kind of works out the way that most likely it's going to, we should probably get down into the 3s by the year end, 3 or 4, right, near year end. And so we're at 4.9 right now. We should see this continue to drop pretty aggressively, and then we should stabilize somewhere around here, and that will most likely get the Fed to kind of start backing off. Unfortunately, what that will also do is it'll make the disinflationary pressures slow down as well, and that'll create another inflationary spike, and then we'll go through another inflationary recession when they retighten. But that doesn't look like it'll project out until probably around mid next year or so, maybe early next year. So remember, inflationary recessions come in a little bit quicker and faster than deflationary recessions. Deflationary recessions are much more spread apart. So even though we are done with the last recession, we are in for another recession, probably, like I said, mid next year or something like that. I'll keep you guys posted, of course, as we kind of go through those. All right, I had another question. Let me just make sure I'm not skipping anything here. I had another question about how to blend our strategies. I did do a whole presentation on this actually over at Aramir for their 0DTE program. If you guys were a part of that, then you kind of already know a little bit about this. But for those of you guys that have started one of these services or are looking into one of these services and are like, hey, there's a couple different products here. So there's Adapt Intraday and then there's the Adapt Daily. They both do work in different ways, but what's really unique about these two strategies is that they marry together really well. And the reason why they marry together very well is because they take their drawdowns in very opposite ways. And so as you can see here, when we're taking a drawdown in the red strategy, which is the Adapt Daily, right? The Adapt Intraday is still going very nice and strong. But then when the Adapt Intraday is starting to take its drawdown right here, then all of a sudden the Adapt Daily is starting to really take off and come out of its drawdown. And this is just a historical example, right? This is going back to pre-COVID, right? So this is about 2020 as far as this data set goes. There's also time periods where we have no trades on the Adapt Dailies, right? And that's kind of nice to have something back here that's doing something, which would be the Adapt Intradays. So anyway, so the question is well, how do I blend these two and things like that? Now, what this graph basically shows is that we are blending them based on equivolatility. And what that would do is, so you look at the, say, drawdowns of each one, and the drawdown of the fully allocated, risk level 3 and the Adapt Daily is, let's just ballpark it right around, 18% or 20% or so, right? That's very close to the max drawdown of the level 3 in the Adapt Intraday. So blending those two together on that allocation at a 50-50 allocation works really well. Now this goes into a little bit more of a complicated question, because then what happens, because each one has an allocation. So I'm going to walk through that just really quick. It's very nice, clean, easy math, but just to kind of walk through those steps. If we're doing both strategies at a risk level 3 at 50-50, then if we had, let's say, $100,000 account, just to make the math easy. So same goes with a $10,000 account, although you're going to run into some sizing issues. So we're just going to talk about a $100,000 account. 50,000 would be going to Adapt Intraday. 50,000 would be going to Adapt Daily. If the Adapt Intraday has a 10% allocation, then that trade that day would have 10% of the $50,000, which would be $5,000, right? Now, if the Adapt Daily, because we've got $50,000 over there in the Adapt Daily as well, if that says that we have a 20% allocation, then 20% of that $50,000 would be $10,000. So that's how we would do it, and that's how we would trade that day. Then the very next day, we'd look at our net asset value, which would be all of our net liquid value, right? That'd be all of our assets that we hold, so all of our trades, everything like that. We'd see what is the account value at, and then we'd do the math all over again for the next day. So the calendars get started, or the Adapt Intraday gets started in the morning. You sit there and look at that. You go, okay, 50% goes over there. So let's say we've made some money. Now we're at 120,000. We take that 120,000, we split it in half. So now we've got 60,000 over there, or 10% of 60,000. That's going to be $6,000. Boom, that's our next trade for the day. So hopefully that kind of cleared some things up as far as how to blend these two strategies. By the way, this yellow in the middle is the blend between the two. So you can see here with blending both of them, they both make a really nice little substantial amount of money here, and they blend the two. So you can see they blend and ease the amount of drawdowns that we feel. So you can see we don't even basically take a drawdown through this time period because they both offset each other very well. So there's other ways to do this too, rather than just drawdown based. You can actually do the daily swings, the daily P&L swings. You can always reach out to me if you want these kind of statistics. Of course, if you wanted to look at what the actual stats were for this type of trading system, we have some of these right here. So here was our standard DEV. Here was our max drawdown was 11%. This is cutting down the adapt intraday quite a bit. We'll talk about that another time. But we were just talking about blending them today and how to do that. So here's some of the stats about the adapt dailies, right? Max drawdown from this time period was about 11%. Just know that this is only back to 2020, and we have data going back a lot further than that. So, but for this example, that's what we were doing. Okie doke. That took care of that. My last question that I got, can we have access to that spreadsheet? Can we have access to that spreadsheet tab? Absolutely. Yes. If you're part of the service, I will make sure that I put it into the forums so that way everyone has access. I'll probably just put it in the general tab, and so you can see it there shortly. I'll probably be able to get to it tomorrow. I'll put that on my task list, okay? All right, the last question that I had sent into me was actually about the Adapt Advanced. So the Adapt Advanced is something that you get a little bit more, you get a little bit more personal time with me. On a weekly basis, we go through, where's the market at? What's some of the technicals? Where are we seeing things? You also get to see what my trade's doing and things like that. Now, the Adapt Daily and the Adapt Intraday have been having a phenomenal year. And they have just, clear as day, they have been beating my personal trades for me doing it my style. Now, all of these are technically my style, but the Adapt Intraday and the Adapt Daily are driven very algorithmically, right? That's done through machine learning and the algorithms that are in place back behind there. So it's very systematized, which is a good thing because you know that there's not subjectivity back here. I feel this. Like, no, everything is very data backed. So as far as the Adapt Advanced, I'm just going to give you guys a little bit more behind the scenes of just kind of what's going on, and just know that there are some of these that actually are very correlated to the Adapt Dailies. And the Adapt Dailies take in some of these things into consideration, but not all. So just know that that's kind of there. So if we look at the Adapt Advanced metric, and actually I'll probably pull you over to a little bit of a bigger screen on this here. So there's a few things on the Adapt Advanced metric. If you're an Adapt Advanced member, you get these types of things. By the way, if you ever wanted to join this, you'd have to go over to our products page or our Adapt Options page, and then you'd have to sign up for a call with me. That way we can talk about kind of, is it a good fit, and where it would fit into your routine and things like that. I want this to be a really good fit. Like I said, you're going to get a lot more personal with me just because I'll talk to you on a regular basis with that on the weekly meetings and things like that. So I'd want everyone to be happy in this product. Otherwise, maybe some of the other products would be better. All right, so the right here you'd see that in general we're going to be in a DTE of 21 to 35 if we're starting a trade today. So that's what that's showing right there. The base structures you can see right now, as of today, we're going to do all calendars. If we're going to use any calendars, keep in mind that the Adapt Advanced is a little bit more of a fluid system. So this is made for a trader that doesn't necessarily want to, color by the numbers like what the Adapt Daily is. They're like, hey, I want to adjust this trade. I like this trade. I don't want to just exit this. I want to do something to it. I want to be able to bend it to how I feel about the markets and things like that. Well, what we try to do here on the Adapt Advanced is we try to strip out the feeling necessarily. Granted, that's there, and use that as much as you want. But we try to say, okay, if you are going to do those things, here are the right structures and the right way to do it, on a quantifiable level. So here right now, if they're like, hey, I want to put on a structure that's a theta-based structure, right? It would be all calendars across the money. Sometimes it's not all calendars. Sometimes it's butterflies. Sometimes it's butterflies or calendars or something like that, right? And then your gamma style, that deals with if we're having to deal with risk to one side of the trade or another. So that goes from tight, stretch, stretch down, or stretch up. All of those basically are telling you which direction is the general energy of the market right now. Right now we've got a tight structure in the S&P, and then charts. This is to where we can be on uh, the right, basically like zoom level for the market. If we're going to be trading at 21 to 35 DTE, you don't want to be looking at a 3-year chart, right? I mean, there's data on a 3-year chart. Don't get me wrong. There's good things there, but basically that's not where your focus should be. Your adjustment structures. So let's say you're one of those persons that like to adjust something. What you'd do here is you'd sit there and go, okay, what can I adjust with right now? Sometimes there's a lot of these available, and sometimes there's only a few. Each one will have an edge in the current market environment. The market environment deals with options pricing, how the options pricing is dealing with gamma in the market and the speed of the asset. And then also it deals with how how options are priced relative to each other as well, right? Across terms, across different strikes, things like that. That's what helps us dictate what is going to be the proper structure. Then, of course, there's always just simple things like volatility, right? There's a lot more complicated things that go into this algorithm. And then there's also the macros. And then, of course, you can see down here what's the actual macro environment. So keep in mind that the macro environment is the largest contributor to what the long-term feeling of the market is going to be. And I say feeling in a very quantitative way, but in general, this macro environment is very neutral bullish right now, and we're actually going a little bit more bullish. I know over the last couple of days we actually kind of came back just a little bit, but we'll see where things kind of settle out over the next couple of weeks. So keep in mind that the macro environment changes, but that is our long-term view. Doesn't mean that we can't pull back, doesn't mean that we're super aggressively bullish or anything like that. Do keep in mind that over the last 2 months, that metric has gone from heavy bearish to neutral bullish. So we've had this very big turnaround. And so all of this recession garbage talk is unwarranted per our metrics. There might be corrections. We're not saying that corrections can't happen, but there is not a recession coming anytime soon. The recession that was basically on the books did not transpire for this year. It has been pushed way into the future, and we will deal with that next year. So, all right, down here a little bit further, you can see that we have daily up move risk and daily down move risk. That's not what we should expect the market to move. That's what we need to be protecting for. If you're protecting for a 200-point move to the upside, that is a lot of wasted energy in a trade. That trade could be a lot tighter and we could be a lot more profitable. If we're trying to cover a 500-point to the downside move, that's also a lot of wasted energy, right? So these are basically our blowout risks to both sides. As you can see here, we have more upside risk to downside risk. That is a rare situation and typically only shows up in bubbles. Now, our general market behavior is very important, and more important is actually the second sentence that shows up. This second sentence is, typically, there are excessively bullish monthly trends with quick, vicious, shallow pullbacks that last only a few days on average. This is very important because what happens to traders more often than not is they believe, and this happened to me too, so don't think that I'm above this, trust me, I fall into these traps as well. But most traders, we believe that what has happened in the market over the recent past is what's going to happen again. Now, over the recent past, now we're gonna kind of dig into this a little bit further. because as I said, I get a lot of these questions. So I'm going to share that screen. All right, so from here, let's turn this back down into a 1-day chart, and we're going to talk about this. Okay, so what has been happening over the last year or so has been these large pullbacks, big ups, large pullbacks, big ups, and then started these smaller pullbacks starting, right? This was still our heavy bearish macro environment. If I can like just boom, all of this is heavy bearish macro environment, right? So big downswings are very common in those types of situations. Also, if you were part of the service back then, which I didn't even have it publicly available yet, but basically, if you were looking at what the indicators I built here are, you would have seen that excessive downward pushes are regular. You'd also show that new lows are common, and you'd also show that expanding ranges at the top ends of ranges are very common as well. You know, there are a few details in there that start showing up in this environment. Ever since this date, except for a couple little selective days in the past, ever since that date that I just drew right there, we have shifted into a totally different market environment. That market environment is that verbiage that I talked about earlier. Excessively bullish monthly trends with very shallow, quick pullbacks that only last a few days. Let's look at what's been happening since then. Excessive bullish runs, 1 or 2 day drops, more excessively bullish trends. That's just what we get. Until that changes, most likely all we're going to see is, even if we do get a drop out of this little bubble that's in the Nasdaq, not so much in the S&P, is maybe a quick vicious down pull. Everyone's going to spaz out thinking it's all the end and the recession's hitting, and then it's just going to go whoop, and it's going to go straight back, right? And it's just as long as this environment's in place. I'm not saying that it's going to stay in place, because the metric picks up on things every day. It actually picks up on things every minute, and it will tell us if things are going to shift. But as far as right now, we are solidly in this environment. So we'd have to have something pretty dramatic to kind of kick us out of it. It doesn't mean that it can't, but most likely we're going to continue this little environment because there is no recession yet. All right. That is basically everything that comes down to the Adapted Advance. The last question that I got on that is, okay, well, what does your trades look like and things like that? I will just go ahead and at least show some things on this element just to kind of show here. Let me get over to that. So joining like the Adapted Advanced, or at least being a part of it, you will see things like this. So I go through a pretty in-depth analysis in the instructional videos if you were to join this service. But basically, each one of these lines means something else, or it means something different. But as far as what's going on, these will be familiar to you if you're part of the system. But basically, this is the general analysis of the market as far as a technical basis. We're not necessarily trying to determine direction in this trading system. We really just care about kind of where ranges are. But we go a little bit more in depth into that in the system. Like I said, it's not like, oh yeah, we're going to go bearish right now or something like that. It just depends on kind of what's the quantitative things. Can we trend follow? Can we mean revert? Those types of things. You've always got access to my chart down here. And then also, you'll see how my trade's doing. Now, of course, we went through this whole bubble. This trade, I think it's actually still flat. We pushed it on. We were actually up just a little bit of money, just a little bit longer. I know a lot of market neutral guys got pretty hammered in this upswing, but we actually came back This trade was down around 8%. We came back all the way to break even, and then I think we were up a little bit of money, and then I came back, and so we're continuing on the trade. We'll probably pull out a nice little gain on this. We look for about 10% in this trade. We can look at 20 or 30 depending on what's going on in the market. You'll see what my last adjustment is. You'll see kind of what things we're talking about right there. I realize that that is a spelling error. But basically, we're leaving the trade open and preparing for our 4,300 targets. Absolutely, we hit that. So, hey, everything's working to plan. You can see here my immediate bias is that we're bubble. I talk about those kinds of things, my general trade plans and what would it take for me to go all in. I talk about going all in, or I talk about going into a tight structure in the teach. So as far as all of that is concerned, that's where we're at this week, and hopefully I've basically knocked out all those questions that were sent to me, and I am going to leave you guys with that unless there's anything else. I will of course give you guys just a little bit of pause if you guys are wanting to type something in or say something that I can answer really quickly. You guys have me for just a second here, and I will give us our nice awkward silence. All right. With that, guys, I don't see anyone typing or sending in any questions. So I'll leave you guys to it, and I'll see you guys next week. It will be at the normal time. I will do it at 3:30 Pacific time next week on Wednesday. And I'll see you guys then. Trade well, trade responsibly, and make lots of money.